All right. Well, good morning to all you beautiful apes out there. And thank you guys so much for joining us today on today's Daily Peel live stream. As you guys know, my name is David, coming at you live from the Daily Peel Global headquarters. Location, of course, undisclosed. Like I said, thank you guys for joining us today. Hope you had a ton of fun yesterday at the live stream and whatever else you were doing in your degenerate lives out there. But today we're going to be doing much the same thing. And do you believe in miracles? That's our main question of the day today, because we're actually getting started on time, going over things about an hour or so into the trading day today. Now, we'll get you prepared based on the stuff that was going on yesterday. Well, no further ado, let's just go ahead and dive right in. Today's issue of the Peel, we got some good stuff going on. We got the quarterly household debt and credit report from the New York Fed, so we can see how much debt that we're all racking up and how much we're never going to be able to pay back. Basically, the big, this is the big reason as to why all of our kids are probably never going to be going to college. And so we'll be able to dive right into that towards the end. We got some earnings reports from Datadog, KKR, even places like Uber that we didn't get a chance to write too much about, but we'll go ahead and talk about those. And then, of course, UBS also reported their Q3 earnings. This is their second report that's going to be with the combined entity with Credit Suisse. So this time, it's actually kind of having an impact on their earnings, unlike the last time. It was, still only integrated on paper. Now we're starting to move along in the process a little bit. Still a multi-year process before full integration, but we'll get into that towards the end here. Either way, just a quick recap of markets at a very, very high level yesterday. Basically, what we saw was a pretty good day overall, unless you were invested in small cap equities. Then you probably didn't have a very good day. The Russell 2000 was down about 0.35%. All the other major U.S. indices were up on the day, with the NASDAQ rising the most, getting a 0.9% gain. It was one of those days that we've seen really since the pandemic began, just large caps leading, very much not a stock picker's market. It's just buy whatever is the biggest companies. But moving on down below, Treasury yields continue to bounce around in their ever so confusing manner. We saw an expansion of the inversion of the yield curve, given the 2-year, rose mildly, was mostly flat on the day, really wasn't anything to write home about, in between that 4.9 and 5% level. And the 10-year did move lower below that 4.6 level, although just slightly. Moving on down below to those banana bits. Like I said, we had Uber earnings yesterday, or I believe it was the day prior our market close. Didn't get a chance to write about it because we got some great stuff down there for you guys instead. But just to go over that real quick, Uber overall did have a pretty good earnings report, even though they did miss on both the top and bottom line. The stock was up about 4% on the day because even though they missed expectations, it was pretty good overall. Revenue grew 11% to $9.3 billion. They increased guidance as well for the next coming quarters, which is really the main driver of the stock move yesterday. But the biggest thing was that we're seeing deliveries increase 18%, mobility bookings increase 31%, and across the board, the three main metrics with Uber being revenue, bookings, and monthly active users, all moving in the right direction. So it was a great report to see, even though we didn't get too much of a chance to write about it there. Then moving on down below, now there's some interesting stuff going on in the banking sector. We have some synthetic risk transfers is what these products are called that's going on. That sounds a lot like something that would have been, released in about 2006, right before the great financial crisis. But either way, JP Morgan's unloading about 25 billion of these things onto the markets. Definitely got to read more into that. And if you don't understand what it is, just ask ChatGPT. Now, actually, ChatGPT was down this morning, I believe, but still, if it's back up, feel free to go check that out. Moving over to the private equity industry, which we do get into a little bit more below. The tale of two cities in this space is KKR had a solid day following earnings, whereas Carlyle only pretty much announced that they weren't going to be giving too much in raises to their employees, and especially not giving those ultra-high salaries to the new hires. Certainly not the salary levels that we saw in 2020, 2021, when things were actually going well in the industry. But down below, homebuilder D.R. Horton had quite the quarter as well. They reported some solid numbers. The stock was up on the day. And even just this morning, we actually got some more housing data showing mortgage rates absolutely plummeted. We'll be writing about that for tomorrow, so definitely stay tuned on that subject. Moving on to today's main story. So yesterday, like I said, we got the household debt and credit report from the New York Fed, their Institute for Microeconomics. We always focus on the macro, but it is the micro that matters as well, even though essentially this is macro, just kind of built out from the micro. But either way, what we're talking about here today is the overall levels of debt and credit in the U.S. economy. And we did, of course, write that a good bit. We saw some decent growth in that subject. But let's go ahead and move over to the actual report itself. So like I said the other day, guys, anytime the Fed releases something like this, you're going to want to go to the PDF viewing because it's a lot better. Now, this is a super boring kind of language information, but if we scroll down to the charts here where all the fun stuff actually is, here, let me zoom out a little bit so I can kind of fit this in the screen for you guys. So total debt balance has increased quite a bit. We've seen, a relatively normal jump up, something a little bit beyond what was typical in the pre-pandemic days. But the number of loans, especially for credit cards, have been staunchly on the rise. Essentially, what we're seeing here is because stimmy checks have ended, the government stopped sending things out, and excess saving balances have really declined in the meantime as well. Consumers, instead of changing up their behavior and kind of reducing their spend or reducing their lifestyles, are instead just putting it all in the plastic, which we definitely can't hate on. The only thing is, I just can't believe some of these companies are giving people like me and you guys actual credit cards, but I guess they trust us enough to go for it. So going over some of the numbers at a high level, like I said, aggregate household debt jumped about, a somewhat normal amount in the 1.3% range, but it's up overall 22% since before we got into the pandemic, which is insane growth in this regard for just a 3 or 4 year period. So that was definitely strange to see. It seems like the debt growth has really exploded since the pandemic. Mortgage originations also fell slightly, of course. I mean, that doesn't really need an explanation, but paired with today's data, that could be an interesting story as well, given that rates are on the downtrend. Now, outstanding student loan debt did increase by $30 billion. Got to start paying those back. I mean, personally, I wouldn't really like to be able to pay those back, but still, I guess we got to do it. Joey B stopped dishing out the cash, so it's kind of on us now. Moving on down to auto loans here. There was a bit of a scare, if you guys remember, back in 2022, that the auto loan market was going to become the new GFC, kind of like real estate before the global financial crisis. Obviously, that didn't happen, thank God. But still, we're seeing delinquencies rise across the board, and that's really the main story of the report here. Delinquency rates increased for all major debt categories except for student loans because, the degenerates and the scumbags like you and me, we're just not paying back our debts apparently. So they're rising at a much faster clip relative to historical norms. And this is coming at a time as well where debt balances are at an all-time high. Rates on those credit card debts are at an all-time high as well. And so it only follows that delinquencies are going to be increasing as well. Hopefully that doesn't absolutely destroy the banking sector, but they're kind of sealing their own fate when they lend money to people like me and you. So definitely not a great idea, but either way, that's something we're going to want to keep track of, even though the next report isn't going to come out till the next quarter. Moving on down below to the stocks that we're moving on the day. We got a big move from Datadog. It's one of those cloud companies that just confirmed that Google is the only idiot in the cloud sector right now. Now, Datadog doesn't do the same thing as Google, Azure, AWS, and all that, but they are kind of an ancillary product for it. I'm hesitant to say that it's like a picks and shovels play because it's not, but you can think about it kind of similarly in the terms of the actual moves of the markets rather than the company's performance themselves. So Datadog is absolutely killing it. Revenue grew 25%. At this level, too, to $547 million, that's super impressive, especially in a year like 2023 when everybody was on Mark Zuckerberg's crusade to just cut costs as much as possible. They were still dishing out cash to Datadog, and even some of the other cloud providers like Snowflake and MongoDB got a boost along with that. So it was very great to see. They beat on the top, beat on the bottom, needless to say at this point. But moving on down to KKR. Now, this, of course, is the industry that pretty much everybody watching this, reading this newsletter is probably dying to get into. It's private equity, it's professional douchebaggery, so it's definitely a great spot for most of us. Now, unfortunately, I wasn't smart enough to get into the industry, so of course that's what we're doing here today. Now, with that comes the lack of authority for me to give you a full-time offer. But what I can tell you is that KKR did have an overall fairly solid quarter. Now, it had nothing to do with the private equity side of the business, of course. It was mostly from their insurance line. KKR is a majority shareholder in Global Atlantic. They're an insurance provider, and much like Berkshire's insurance business that we just talked about the other day, it was solidly outperforming so far this year and especially last quarter. Now, AUM did increase 6.5% as well to $528 billion. The company was able to close a couple of additional funds, namely its Next Gen Tech and Global Impact Groups. These are two of the biggest ones that they've been hyping up in the media lately as well. So investors were very pleased to see all that going on. Now moving on to the rotten part of the market, really stinky stuff going on over here. We have Emerson Electric. Emerson is one of the most boring companies that I've ever seen in my life. I almost fell asleep while I was writing this part of the Daily Peel yesterday. Even though earnings weren't terrible, they came in just a penny short of expectations at $1.29 instead of $1.30. Sales growth wasn't terrible either, rising to $4.09 billion, but obviously it was still short of expectations. Now, the company is getting involved in the Internet of Things, but they had the absolute audacity to call themselves a leader in automation, or into an automation leader. They said they're becoming with their acquisition of NI. Now, that sounds to me like they're trying to cosplay as NVIDIA or something else like that. Really hate to see it, but still, so did the market, so we're glad they got punished for it, down 7.41% on the day. Moving on to this absolute piece of garbage, we have AMC. Don't know who still holds this. I think if you still hold this, they should probably take away your brokerage account, although they definitely should have taken away mine quite a while ago. But I'm still going to hate on anybody that owns AMC. These guys are reporting earnings later today, so I'm sure we'll all get a good laugh out of that. That's really was the only explanation I could find for why the stock sold off so much more than usual yesterday. But still, definitely stay tuned for around 4:30 p.m. when those earnings drop. Moving on down below to the arranged marriage between UBS and Credit Suisse. Let's check in on exactly how that's going so far. It's been 233 days since this was forced into one on March 19th with the $10 billion backing from the Swiss government. Then the merger was actually completed on June 12th. That's just 148 days ago. So we can kind of see that things are going fairly smoothly. They're moving along much quicker than would have otherwise been expected. But their earnings are definitely feeling some of that pain here. We can move over to the UBS equity report. Now, try not to fall asleep as well as we go through this. I promise we won't be on it too long. I just want to give you guys a reference point for what I'm talking about. I also want to point out I did go with showing not the actual 10Q itself, but the earnings release that came along with it. And really what we're looking at here is the net profit attributable to shareholders. This is their This is their equivalent of net income. All right, I'm going to stop doing it. But look over here, $785 million loss. That's quite the change up from years past. But this is very much due to general and administrative expenses, as well as we saw some other staunch jumps in other expenses as well from personnel. So it's likely from having to pay Credit Suisse employees without kind of getting the requisite business growth. Although one of the big stories on the report was that Credit Suisse lines of business did actually see some inflows in assets overall. Don't know who's dumb enough to give money to Credit Suisse, but with Bitcoin being down 50% this year, guess you got to launder your money somewhere, and Credit Suisse obviously is a great place to do that. I'm pretty sure that's how they even advertise themselves. So obviously, naturally, I'm one of their top customers in that sense. Now, they still did get a solid boost to operating income. I believe it was named after a great Jay-Z album at $444 million on that operating income line. And then Sergio Armati had some comments to make as well. He's the guy that they brought back in to replace Ralph Hammers because that bumbling idiot wasn't able to complete the Wealthfront acquisition, so they basically booted him. Now, Sergio's back. He led the company for years after the GFC and really did a great job. Investors love the guy, and he's part of the reason that the stock has been performing pretty well since then. So we did see overall somewhat solid performance, particularly in the wealth management division that UBS and Credit Suisse both kind of started to lean into about a decade ago or so. UBS did lean much more into that, and it's performed well since then. But either way, revenue still managed to soar 23% in that time, up to $11.7 billion, beating expectations. CET1 ratios, this is basically the capital ratios that tell how easy it's going to be for the bank to knock over. If the CET1 ratio is pretty high, you can assume it's made out of bricks. If it's pretty lower than like 12%, especially lower than 11 or 10%, it's going to be looking like a paper house, and it's probably going to blow over when the wolf comes. But still, the notorious secretive bank hasn't given a whole lot of guidance. They did tell us that next quarter should be looking somewhat similar, and they're just expecting these improvements to kind of come along with time. And that was pretty much the main stories for the day. Solid earnings report. I should mention as well, UBS stock was up on the day. I don't exactly remember how much it was. I believe it was, in the low single digits of percent. But either way, it was great to see that stuff still going along well, because that kind of collapsed. That would not be great for you, me, or the entire global financial sector. Finishing off with today's quote of the day, really Mark Twain, and the lack of money is the root of all evil, going back to those debt levels pumping up. Because when you're taking out debt, that is exactly a lack of money. So really, Mark Twain could be getting at the fact that a debt buildup is the root of all evil, and that's exactly what we're doing in the U.S. economy. So on that very positive note, I'll be happy to let you guys go and enjoy the rest of your day. Hope you Californians enjoyed getting up here at, what time is it out there for you guys? 7:41 in the morning. Hopefully you're listening to this on your way to work or anything else like that. But either way, it's great to see you guys again. I'll see you at the same time tomorrow, and thanks so much for joining us again. Happy trading.